Hey, what's up YouTube? Welcome to the Live Econ Guy. In this video, I want to look into the interaction of long-run interest rate spreads, so the difference between the 30-year mortgage average and the 10-year treasury, and that interaction with the assets held by the Federal Reserve. And how I'll be looking at that, I'll show you in a bit. I'm taking the natural log of the total assets held by the Fed and the mortgage-backed securities that are held by the Fed. So guys, recently I've been seeing a lot of articles and a lot of kind of news coming out pretty much critiquing the Federal Reserve and Jerome Powell's recent guidance, essentially saying that the Fed is going to continue to tighten and increase the short-run interest rates, which is the federal funds rate, as well as allowing assets to roll off of their balance sheet, which is essentially going to drain money out of the system if that happens the way it's planned to happen. But I think what's also going to happen in the future, in the near future, is that the Fed is going to start to sell some of the assets that they're holding, especially the mortgage-backed securities, because those are not running off. And what that's going to do is that's going to increase the long-run interest rate, which is essentially the yield on the 10-year Treasury, which in turn impacts further the 30-year mortgage rates, as well as the other mortgage, like the 15-year and the other ones that they have. So guys, what I want to do is I want to show you this graph that I've been working on. So it's the interaction of long-run interest rate spread and assets held by the Federal Reserve. So on the bottom you have this line, which is the difference of the 30-year mortgage rate and the yield on the 10-year Treasury security. So you can kind of see there's been instances where the interest rates on the 30-year mortgages go down a lot, as well as the Treasury yields. Those can go down even more, which is what happened if you look on the right-hand side with the COVID situation. We also have the orange line, which is all assets held by the Fed, and I'm taking the natural log of that. And then I'm also taking the natural log of mortgage-backed securities that are held by the Fed. This allows us to essentially look at all of these together and see how they move together and their interaction. So if you look at the 2008 crisis, what happened is that the Fed allowed some of their assets to roll off of their balance sheet. They might even have sold some. What that did is that increased the yield on the Treasury securities. Specifically here we're looking at the 10-year. What they also did during that time, guys, is they hiked interest rates a lot, especially the ones on the 30-year mortgages. So that increased that spread during the height of the crisis. You can kind of see in this graph it peaks out at about almost 3% spread between the 30-year mortgage and the 10-year security. What happened after that is that the Fed bought a lot of mortgage-backed securities and U.S. Treasuries from the private sector and from the U.S. Treasury. What that did is that it decreased the 10-year Treasury rates and the rates on the other Treasuries and bonds that are sold, and they also lowered the federal funds rate, which in turn impacts the mortgage rates, and that essentially dropped that spread quite a bit, as you can see. Next, I want to look at the roll-off that happened between 2016 and 2019. What you can kind of see is that these assets were rolling off, which didn't really impact the bond market much, surprisingly. So the 10-year Treasury was not impacted as much as you would expect. The reason is that the assets that are held by the Fed, they pretty much expire and they don't saturate the private market. So it's not like they're going out to the private market and selling these, and in turn there's more bonds available, so when new ones are issued, they have to be issued at higher rates. Now, when we look at what is currently happening, so the very right side of the chart, the Fed is allowing these assets to roll off, so you can kind of see that the line is kind of flattening out. And I think it's going to start to kind of what happened in 2008, essentially the orange line and the gray line, well, the orange line specifically in this case, is going to start to go down a lot. And the result is going to be that the spread on the mortgage rates and the 10-year security is once again going to increase, because uh, the the yield on the 10 years is going to have to go up, because if you saturate the market with bonds, um, any new ones issued is going to have to be at a higher rate. So I think it's a really interesting chart personally. Kind of says that when the Fed sells assets, the yield on the 10-year goes up, and when they buy a lot of assets, the yield on the 10-year goes down. And then you have that spread between the 30-year and the 10-year, sorry, the 30-year mortgage rates and the 10-year. So yeah, that's it for that, guys. Next, I think what's really interesting right now is also looking at the 6-month Treasury yield. So it's currently almost at 4%, which, I mean, it's been going up all of 2022. I think what's happening is the bond market is essentially predicting that the Fed is going to start selling these assets into the private sector, and as a result, they're kind of, well, there's been a lot of forward guidance provided by Jerome Powell, the chairman of the Federal Reserve. He's been saying that the Fed is going to be aggressive in fighting inflation. So one way is to sell these assets. And I'll leave some links down below for you guys to check out. I think it's really interesting what's going to be happening here, especially next week. We have the next FOMC meeting where they're going to essentially announce the continuous policy of, I think, quantitative tightening. What this means for an investor in the future, I think, is that the bond market is going to be more attractive than the stock market for any investors, for anyone that actually has cash to invest. So pretty much what's happening right now, the Fed is increasing the short run interest rates, which is the federal funds rate, and that tightens the amount that you can consume. So you're going to be essentially, what they're doing is they're encouraging you to consume less. On the other side, they're going to start to sell mortgage-backed securities and maybe even treasury securities, and that's going to increase the long run interest rate, which is essentially the yield on the 10-year treasury as well as the other treasuries. So instead of consuming and causing all of this inflation, the Fed is going to try to have you invest into maybe, the 10-year treasury or even the 6-month treasury, and you get this very high yield. And I think it'll only continue to go up. So currently the 6 months stands at a 4% annual yield, and the 10-year is at around 3.5%. So I think that it'll keep going up, given that the Fed continues to tighten monetary policy. Anyways, thanks guys for tuning in. Once again, I appreciate any likes and comments. I think the algorithms spread this video around so we can get more discussion going. Thank you and have a great night.